Trinh Nguyen. She's senior economist covering emerging Asia at Natixis, and spoke very well about what was happening in the Indian policy, growth and markets until around September, October, wherein she expressed some skepticism around slowdown. And the markets have played out that way. And which is why I think it's very important at this current juncture to try and understand how does Trinh see both the sentiment, the kind of work that the country is doing around attracting global FDI, and the mood around emerging markets by and large. Trinh, great having you. Thank you for taking the time out. It's been a while, but good talking to you.
Well, thank you very much for having us.
The pleasure is entirely ours. Now, I saw, Trinh, something that you posted on X, wherein you mentioned that it is up to each country to try and make the most in terms of attracting money, and not all economies are doing that. The shifting global supply chain, of course, from the trade war thereof. And you named 3 or 4 countries which were doing that, including India. Could you elaborate on that first, and then we'll move on to other matters?
Absolutely. I think, you know, there is every day there's news of the tariffs regarding Trump. But if you look closer, it's much more targeted than people think. Whether it's 25% on aluminum and steel, or his promise on certain sectors, autos, pharma, etc. But what's very clear is that there's higher friction to trade with China, which is 10% higher, and that's already on top of pretty high tariffs, right? And given the role of China in global manufacturing and this deterioration of US-China relationship, there is a fracturing of global supply chains. There's great disruption. With great disruption, there is great opportunity. But not every country is viewing this as an opportunity that they want to grab, right? It's not every country in Southeast Asia or in emerging Asia see that as an opportunity. A good example is Indonesia. Indonesia sees metals and mining, moving up metal mining, as a much more bigger opportunity than manufacturing itself. As a result, there's not significant incentives to try to attract this. A country that's much more aggressive is really Vietnam, and to a lesser extent India, with the Make in India and the PLI. Within the PLI for India, it's really they're focused mostly on the on ICT, semiconductors, so mobiles and components of. If you look at the budget, that's exactly it. What they target is the lithium battery. So it's a very targeted way to do it. So my argument here is that India can broaden that further. India, if you look at the cyclical slowdown that's happening and a disappointment towards earnings, it's really this really elevated expectations for where India would go, right? It's not, 6% is not enough for a country like India. People want 8%. To achieve 8% out to growth, you have not just consumption, but investment, right? Historically, in the past 10 years, it's really the public sector investment. So we really need this private sector engine to be roaring. So the big question is, how is that going to move forward, right? So the RBI is cutting rates, is trying to ease some liquidities, but fundamentally, it's really putting the animal spirit into India's private sector. And I think the way to do that is to emphasize areas in which it can support sectors to prioritize beyond just ICT. I do think that some more significant support extend beyond high tech into labor intensive. There's a little bit of focus on toys and textile, but the amount is still too small. And the second thing is not so much the money amount, but it's more the policy focus. And I think that's a policy narrative that needs to be driven much more aggressively by the policymakers in India.
Okay. Now, Trinh, the Prime Minister Modi, Donald Trump bonhomie notwithstanding, people thought that the meeting and then the subsequent comments by Donald Trump around reciprocal tariffs on April 2nd, etc., meant that it left a lot of people on tenterhooks about what could possibly come in, because a lot of Indian sectors might be vulnerable to reciprocal tariffs in the eyes of a few people. I would love to understand, if you've given this some thought, what do you think of it?
Well, first, I think average effective tariffs, because when you talk about reciprocal, it's going to be too cumbersome to go into every single item, right? So let's just paint broad strokes. The average effective tariffs between the U.S. and India, they're very different. India, as you know, is a much more protective country because it's an emerging country. And the idea within India has always been that we need to protect our market from the floods of foreign goods because we need them to allow them to develop to a certain level before we can lower tariffs. And if we lower, it must be much more targeted in sectors that we want, right? And so as a result, India has had one of the highest tariffs in the world for imports, right? And I think in my opinion, and I think the Modi administration has targeted that well, is that it should target on sectors that the U.S. wants to protect and it's important. The U.S. is an economy that's capital intensive, labor is very expensive. It is not in India's interest or even President Trump's interest to really, and as you can see his actions so far, he's not going to impose tariffs on everything, right? It doesn't want to become self-sufficient at everything. There are just some areas where they want to grow their market access further, right? So I do think from that point of view, there's room to be done. For example, if you look at Modi and Trump trying to raise bilateral trade, not just in economics to 500 billion in the future, not just in oil and gas and importing hardly deficits, but also on the security side. So I think there's a lot of room for further improvement, and it's really not really against what India is trying to do, which is trying to grow ties with the US. I do think that this is a great opportunity for India to start to think about diversifying trades and growing out its exports further, right? The key idea here is that while India does have a trade surplus with the US, I do think that there's much more aggressive growth that India can do in terms of exporting elsewhere, and also even to the US, that growth could be much higher. And the reality here is that for what's happening in India, it's really about growing the middle class and growing jobs and all these different ideas of trade, investment, private sector investment within India. It's really tied to that narrative. Is that frankly, at the end of the day, India does need to attract much more investment. And while it's a difficult juncture, it is a very attractive market. It does have huge labor forces. It does have a lot of domestic demand. Even the domestic demand is slowing. It is still growing in its imports, right? You can see that in the trade deficit, it's rising, right? Particularly its trade deficit with China. And so what that means is that there's still a very large domestic demand market that Indian companies can tap into to serve. And that can be two birds with one stone, which is ability to kind of grow outward this kind of difficult problem of high informal employment and growing outward. And how do you go about doing that really? To continue to focus on what it needs to work on, which is infrastructure building, liberalization of trade, improving competitiveness for not just foreign firms operating in India, but particularly for Indian firms themselves to have to face a lot of hurdles regarding land, labor reform, red tape, and I think that's an area of significant opportunities. And perhaps the trade war is a way in which that India can do so. And I'll give you an example. I also look at other countries like Vietnam, right? So while Vietnam is facing the threats of Trump tariffs as well, given its high trade deficit with the US, the government just passed a significant budget to improve infrastructure. Because, one of the ways to compete in global trade is, of course, lower costs and high productivity. And the way to lower costs isn't just via tariffs, to avoid tariffs and to have access in terms of liberalization of trade, but also to lower costs of doing business, right? Whether it's regulations, whether it's infrastructure, whether it's things are getting in the way of people manufacturing things and going about in commerce. So I do think that this is something that the government should continue to press ahead and not being so dispirited by the ongoing spirits of trade war.
Okay. Trinh, now the other aspect is, I don't know how much you look at EM as an asset class and flows thereof, but in case you guys at Natixis have some view, we've seen significant outflows from EM ex-China, ex-Japan. presumably towards the US. At the same time, we've also seen FIIs taking a liking to China post DeepSeek. And in the last 3 weeks, there have been significant inflows into China as well. India has seen dramatic outflows, and the FII weightage or FII view on India is the highest underweight since the last 15, 16 years. Now, my question to you is, and not directly connected, but if you have a sense of the appetite for India, which is so low right now, does it come back with growth being shown? Or is there some global event that can bring back the appetite for India?
Well, you can say the appetite for India is huge, right? Given the high valuations. So I would say that we're going through a cyclical slowdown in India. And that cyclical slowdown, there's a big uncertainty, I think, for a lot of people is how long it's going to last, right? Obviously, there are rate cuts happening, but and of course, if you look at India valuations from the market cap, it went from 1-something trillion to 5 trillion, now declined to about 4 trillion. So it's still a huge market cap, particularly also relative to GDP. So I wouldn't say just because that there are outflows at the moment that investors are completely turning, and this is a cyclical reshuffling. The Fed is cutting rates. In a Fed cutting rates environment, a lot of high yielders are not doing really well. High yielders tend to do well in a Fed hike cycle. In the past, that happened because why India was growing really fast, rates were really high. In a low yielder, so there's an adjustment, right? In terms of, they people have overshot China, for example, so there's a bit of a reshuffling that's going back. Valuations in China continues to be quite depressed. It is getting a lot better, particularly because now people are seeing that perhaps we should look at some of this value play, given that. And I think there's always been that idea. So I do think it's a healthy correction. The fact is we want to make sure that this is not going to be prolonged too long, right? And I think that is why I think for the Modi government, there's needs to be more significant reform to bring attractiveness to basically to make sure that this cyclical slowdown is only a short-term blip and that it will be rebounding to a higher level. And to rebound to a high level in a fiscal consolidation phase, what that means is that the government is taking a step back in fiscal spending. It is still spending, but much less. Then you really need private sector capex. And to get private sector capex to get really excited is for them to get much more support from the government. In terms of streamlining the business, the government is doing that regarding rate cuts, but I think more could be done.
Okay, I have one final question, Trinh. What did you think of the recent moves? I mean, we had a NDTV Profit conclave wherein various people came in and said that while India was in this growth slowdown, we probably passed that, and the government and the authorities at large have taken some moves. The budget put in some money in the hands of the consumer. Maybe that helps fiscal consolidation on track. The Reserve Bank of India, in addition to all the liquidity measures, have also gone ahead and cut the rates by 25 basis points. And capex has picked up since December in India. Do you think the powers to be have played their cards, and will it show up maybe in the numbers in the months to come?
Well, I think there will be more rate cuts. I reckon that there could be still another 75 basis points of cuts coming for the RBI. I do
even
think
if
that,
even if the Fed were to be hawkish, you think RBI will still cut rates?
Yeah, I think in the short term they might pause, but I do think that they will continue to support liquidity conditions. And the dollar itself is on a softening path, so that would provide some support in space. In terms of fiscal policy, of course, the income tax cuts were pretty helpful, but I think the share of them is too small. And I think the fundamental idea here is that I do think that there needs to be much more aggressive focus of the government to grow beyond the ICT sector. I think the ICT sector is an area that will continue to grow. There's this big coverage that talks about how increasingly Apple is going to produce more phones in India. But I think India needs to also expand to other sectors, right? It's just a huge population. And I think the key concern here is that we're going to miss the boat if India doesn't do much more to attract investment within the country. And I think an area of a missed opportunity is in the labor incentive sectors, where it's much less sexy to develop, right? So I do think that there's much more space for the next budget to refocus less on the agrarian sector, but more on manufacturing.
Okay. Trinh, Nguyen, always great talking to you to get a sense of how somebody perched at where you are thinks of India and the surrounding regions. Thanks so much for speaking to us today.